Hello and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. In this edition, we're going to take a hard look at the second quarter GDP numbers released by the CSO last Thursday. There's already been a great deal of commentary in the business and other dailies, and most of it has been broadly positive. But GDP numbers very often conceal as much as they reveal, which is not surprising given how complex and technical the entire exercise is. So in this edition, we're going to try and add value by looking beyond the numbers per se. We're also hoping to give you some sense of what we can expect in the coming quarters. And who better to do that with than two eminent economists, Dr. C. Rangarajan, chairman of the former Prime Minister Manmohan Singh's Economic Advisory Council, also former Governor Reserve Bank of India. And mind you, these are just two of the many hats that Dr. Rangarajan has worn in a long career in public life. I also have Anant Narayan, senior economist who keeps a close watch on developments in the macroeconomic arena. Welcome to the show, Dr. Rangarajan, Anant. Let me start by asking each of you in turn, what is your broad take on the numbers, both the overall GDP numbers and the sectoral growth numbers? How should we look at these numbers on a year-on-year basis or sequentially, and why? Let me start with you, Dr. Rangarajan. Given that almost any number was bound to look better compared with last quarter's GVA of 5.6%, which is the lowest in the past 13 quarters, should we be a little less celebratory and more circumspect in our reception of these numbers, especially since the share of gross fixed capital formation in GDP has actually declined further? Dr. Rangarajan?
Well, the reversal in the trend is a welcome sign. After 4 quarters, we have seen one quarter in which the growth rate has been higher than the previous quarter, and therefore to that extent it's a welcome sign and it's a welcome news. Yes, 6.3% or 6.1% in GVA is not necessarily the best performance for the economy. I think there is a long way to go before we can achieve our potential. But the point is that there are a few things which point to some recovery in the economy. I'm not worried about the fact that agricultural growth rate this quarter is second quarter is lower than the first quarter because we had a very good agricultural year earlier, and therefore agriculture doesn't grow that fast year on year in a consecutive fashion. Therefore, this extent of increase in agriculture itself is really good information. The other thing is that manufacturing has, or industry has shown much better performance than quarter one, and therefore that is really a heartening tendency. As you yourself remarked, if you look at all the numbers, the one thing that still bothers one is the fact that the gross fixed capital formation rate is in fact lower than what it was in the previous quarters. That trend which we had been seeing for the last several quarters has not been reversed, and that is really a disturbing thing, particularly because the public expenditure or the government expenditure have already reached the limits as far as this year is concerned. I do not see in the coming quarters government expenditure being at a much more rapid pace because of the limitation of the ability of the government to spend expenditures. They have already done their maximum in the first 2 quarters. Therefore, given that situation, the importance of private investment becomes critically important. Therefore, as I see it, I do find that there are some signs which are encouraging, and probably we have seen the decline in the growth rate bottoming out. Therefore, we can see further rises in the rate of growth in the coming quarters. But unless action is taken to quicken and to activate private investment, long-term sustained high growth is going to become difficult, and that is where all focus and attention is needed.
Would you agree with that assessment, Anant? And how wise is it to kind of draw any conclusions based on the performance of one quarter? And would you also say that S&P was not only being a little unfair to us, but as is the want of rating agencies, has not called right? Anant?
Absolutely, Mythili. I agree with everything that Dr. Rangarajan said. I think he put it very, very nicely. On the GDP, GVA numbers itself, I think there is something in it for everybody. The first sentiment which I saw when I saw the number was one of relief. You mentioned that it had to be a better number. I don't think that was quite the case. There was, the last quarter's number was a shocker, and we were all having our fingers and toes crossed that we don't get a shocker again. So a 6.3, 6.1 was a welcome relief and change in trend. And if you add to that the fact that, the effect of demonetization and the teething problems of GST are probably behind us and things should be getting better from here, I think there is a reasonable optimism that, from now on, the worst is behind us. The numbers should progressively go up, and we should head towards 7% kind of numbers again in a couple of quarters from now on. So the first sentiment is definitely of relief. Having said that, there is also a question of uncertainty. I think Dr. Anant also alluded to some of the issues in this particular number and print. As long as GST is still under implementation and we transition from the sales tax estimates to a better estimate, we will have uncertainty. I think the bigger uncertainty is also about the unorganized sector. As I understand it, the quarterly GDP numbers or the GVA numbers extrapolate unorganized sector numbers from looking at IIP and looking at the organized sector. And that might have broken down because of demonetization and GST. So that uncertainty, unfortunately, will remain with us, and we'll probably not know the answer to that for many quarters now until the final data comes out. The third part is there are issues and weaknesses which still remain. I agree with Dr. Rangarajan. I think agriculture, we shouldn't be too worried about that low print because it is coming off a very high base. Having said that, a soft number in agriculture and construction, the two most employing sectors, is not good news for us. We don't have a measure of employment which is reliable in this country. We all use anecdotes to project what's happening. But looking at these two sectors doing kind of on the softer side, I don't think bodes well for employment. The other real risk is that, so far we've had significant tailwinds in terms of oil prices being low, commodity prices being low, and food prices being low. How long we'll enjoy those tailwinds, we don't know. We just can hope and pray that kind of trend continues. Also, of course, the global context, when the Fed starts to unwind its balance sheet, what impact it will have on us and emerging markets, one really doesn't know. So the global tailwinds, hopefully it will still remain and not queer the pitch going forward. The last bit is optimism. I think there is still a lot that we can do. As I said, A, hopefully the worst is behind us. B, I think once we get this insolvency and bankruptcy proceedings going and resolving some of the stressed assets, hopefully, and the banking sector reforms come through, there should be upside. Second, while GCFC is looking pretty soft, I think the capacity for us to invest is quite large. Look at 20,000 crores of savings going into equity markets every month. There is definitely money waiting to be invested. All we have to do is find the right channel so that it goes into the right sectors of education and water table management and low-cost housing, etc., which hopefully we'll figure out a way going forward. So all in all, I think there is something for everybody in the GDP, GVA numbers. On S&P, look, it's a discussion by itself, Mythili. I think rating agencies have historically always been very conservative in assessing India. And markets have always given India, much better prices than indicated by the ratings by either Moody's or by S&P.
Absolutely. Too many pieces in the jigsaw puzzle. But Dr. Rangarajan, one of the biggest puzzles really is that what are the drivers of growth in the Indian context? The economic survey pointed out that no other country has grown at upwards of 6% despite falling investment, falling credit, poor exports. So what are the drivers? Can we dare to hope that productivity might have increased and the ICOR might have come down? Dr. Rangarajan?
Well, ICOR behavior is very difficult to judge. I mean, if you look at it from the behavior of ICOR in 2007-8 and now, yes, ICOR has not really improved. But if you look at the last 3-4 years, yes, it has shown improvement in terms of efficiency. Therefore, what we really need to look at is two things. First, what can be done to raise the level of investment? And secondly, what can we do to improve the productivity of capital? So these are the two things which ultimately drive economic growth. The concern is the fact that the new investment is not happening at the rate at which we would desire it. If anything, the investment ratio is falling. and it has almost fallen by 10 percentage points from the peak that we had reached in 2007-8. Therefore, we need to focus on both raising the level of investment and improving the productivity of capital. Now, the productivity of capital can be increased both from actions taken at the policy level and actions taken at the micromanagement level. At the policy level, for example, there was a good deal of talk earlier about the fact that problems relating to land acquisition, problems relating to environment were coming in the way of speedy implementation of projects. Now, whether they are still the relevant ones, I do not know, and I doubt very much. But I think we really need to do at the policy level a set of actions that will actually engineer a greater level of private investment. And the public investment should be looked at from the angle of not only what it will do directly to infrastructure, but also to promote private investment.
Anand, Dr. Rangarajan spoke about what needs to be done, but my question really is, what is driving growth even now, given the fact that we have so many adverse factors? What is driving us that growth, 6.3%, 6.1%? What is driving the present growth?
Mythili, I'll give you a simplistic answer. The reality is we are still a very young country. We have 1 million people coming into the workforce every month, most of them going into the unorganized sector or staying unemployed. 12 million jobs being created every year. That alone has to give you some amount of growth, irrespective of what else happens. And plus, we are an underemployed population. So to that extent, I think every year we will see improvements in productivity, and we will see, even if it's not being measured completely, I think we will see improvements, and therefore a basic GDP growth. But again, while you question as to why we are seeing 6% growth, I think we will all agree that 6% or 6.3% is really not enough. We need far better growth to give employment to all those young population coming out and seeking jobs, and to improve a lot. At $1,700 of per capita income, we still have a long, long way away before we can claim to be a middle income country, let alone a developed country. So clearly we need much bigger growth than we are right now. The first question one would ask is, if as a private sector investor, why should I invest right now when I already have low capacity? And plus, there is a prospect of more capacity being released as and when all these stalled projects or these insolvent projects come on stream and start to increase capacity. I think that remains a dilemma for the private sector. The answer is, I think we still are short of infrastructure and capital investments in specific areas.
It's time for us to slip into a very short break, so allow me to interrupt you. We'll be back very soon. Please do stay with us. Welcome back. You're watching Macros with Mythili, and I'm in discussion with Dr. Rangarajan and Anand Narayan on what is the story behind the GDP numbers. Can we pass the numbers and get a little greater insight? Dr. Rangarajan, how important are exports in the growth process? There are many who say that unless exports pick up, growth cannot pick up. But is that a correct argument in today's scenario? Or is the export-driven model dead? And for two reasons. One, global trade can never get back to the boom years in an increasingly protectionist world. Two, the main case for exports is that it brings in much needed forex, and it makes domestic industry competitive. And though it is better when we earn forex through current account rather than capital account transactions, is the relevance of exports less in today's scenario, especially when we are getting enough capital inflows, Dr. Rangarajan?
I think we should essentially look at exports as a means of raising the demand generally, and therefore leading to higher level of production. We are no longer live in a world in which we are compressed. I think we are integrated with the rest of the world, and we should take advantage of the fact that the external world offers an opportunity for the sale of our goods. I think we used to talk a great deal earlier about export-led growth and so on and so forth. I think that is not the relevant approach. What we are essentially saying is, if demand is an important driving force for economic growth, demand can be broken up into domestic demand and external demand, and therefore to the extent to which external demand can be accelerated, that is, exports can pick up, it is good for the economy. In fact, I had looked at the data earlier. Much of the decline in the export growth and in the earlier period also was in consonance or was in tune with the decline in the overall world trade. Actually, the share of India's exports in the total exports did not fall too much. I think it was only a shade lower. Therefore, much of the problem lies with the external world. But fortunately, the external world is now picking up better, and therefore we should really take advantage of that. People do talk about the exchange rate. My own studies do not show the exchange rate to be such a strong influence, but nevertheless the exchange rate of the rupee is no longer determined only by the current flow of goods and services. It is also being determined by the capital inflows, and with the larger amount of capital inflows, the rupee remains more stable, but that is not necessarily the correct reflection of what is happening on the merchandise side or in the current account side. Therefore, we should not let the rupee appreciate in real terms and should work towards maintaining the value of the rupee in real terms unchanged rather than letting it appreciate. But that is not the real factor. I think that is not the major factor. We need to look at the entire competitiveness of our exports and see whether we are in a position to be able to compete effectively in the world market. Exchange rate is only one element.
And then Dr. Rangarajan spoke about the exchange rate, and that is something that is right up your sleeve. How important really is the exchange rate? Should the RBI intervene more and then try to mop up the consequences? And I also want to touch upon a point that Dr. Rangarajan mentioned about external demand adding to demand and hence helping. But I thought that domestic demand was constrained only by lack of purchasing power. So surely our large domestic market could make up for the lack of external demand. So how important really is our exports in the entire growth process in today's scenario? Anand?
Well, Mythili, many levels to your question. First, I think both are important. We need domestic demand and we do need export growth as well. On the export front, I agree with Dr. Rangarajan. I think the reality is our exports as a proportion to global trade has not come down by that much. But I think where there is a bit of concern in the recent past is while developed market growth estimates are going up marginally over the last few quarters, and generally the West seems to be doing a lot better now, 3% plus kind of growth on a consistent basis. Europe, US, Japan are all looking good. Our exports aren't really growing at the same pace. Every other country seems to be doing better at exports than us. Now, I'm hoping some of it is because of transient reasons, such as GST implementation and other such issues, or maybe even demonetization. I think it will be very interesting to see how exports pan out from here after a couple of months of very, very low prints. On exchange rate itself and the impact on external trade, yes, the elasticity of export growth to changes in exchange rate has not been established, and therefore economists will tell you that exchange is not a determinant to exports. But where I do think it's a bigger determinant is on imports. If you see the last few quarters and months of import data, all our components of imports, whether it's oil imports, whether it's gold imports or non-oil, non-gold imports, have been going up. And I do think if you look at our own consumption patterns of buying electronic goods or sourcing even simple manufactured goods from China, the broomstick you buy in Big Bazaar is made in China. I do think exchange plays a bigger role on the import side of the equation than on the export side. And to that extent, that's not good news for domestic industry. If you're sourcing even simple manufactured goods from outside because of logistical reasons or because of exchange rate reasons and a host of other reasons, that's not good news for us. Lastly, on the appropriateness of the exchange rate, yes, if you look at it, the last few quarters, our permanent flows, the way I define permanent flows is current account deficit plus FTI plus even FCI in equity, have actually started coming down again. Because the big tailwind we had of low commodity prices and low oil prices, which brought down current account deficit over the last 3 years, that's starting to go away. Now suddenly our permanent flows are zero. So almost the entire accrual of reserves being done by the RBI is being funded from non-permanent flows. And it's not all ECBs and just borrowings. It could be things like, people taking on unexposed, unhedged exposures. It could be things like exporters selling and importers not buying in the forward market. So I think there is, and plus FPI in debt, which comes in and can be pretty volatile in terms of flows.
Dr. Rangarajan, I wanted to shift to another area because I seem to be amongst the very few who seems to view the new IBC, the bankruptcy code, especially after the recent ordinance, as potentially destructive of the nascent economic recovery because it virtually rules out all of corporate India from the resolution process. So while it is important to penalize errant borrowers who have defaulted, especially on account of fraud, is it not dangerous to taint all bad loans with the same brush? Because in the process, we run the risk of pushing a disproportionate number of these loans towards liquidation, resulting in huge haircuts for the banks. Wouldn't it be better to set up something like the US TARP, the Troubled Assets Resolution Program, because that way at least some value would be served, Dr. Rangarajan?
Well, I think whether these are exclusive things, I do not know. I mean, as far as the insurance, in the insolvency code is concerned, I think it's a right approach. I mean, I think that one can't fault the approach. This is the only way in which you can force some kind of a fear in the minds of the people that if they don't behave well, then there is a price to pay. Therefore, I think the insolvency code approach is an extremely appropriate way to do it. Now, whether we are able to get anything out of it and whether the legal procedures that we adopt are sufficiently strong and quick enough. After all, the whole idea of introducing such a code is that we get things resolved as early as possible. But if there is considerable delay even in this procedure, then much of the benefit that we are talking about would be lost. Therefore, even though I didn't get fully what you said, the asset reconstruction companies, which were also thought of as one way of doing it, is really is not really going to be very successful unless there is some fear in the minds of the willful defaulters. Therefore, we need to approach, we need to have asset reconstruction companies along with, I believe, the insolvency code.
Anand, can I ask you to stick your neck out on that, or shall I actually ask you a safer topic, which is what do you think is the new normal for potential GDP growth? And should we give up hope of an 8% plus growth in a scenario where oil prices are increasing, the world is turning increasingly protectionist, and even the economic survey said we must moderate our expectations. So should we moderate our expectations, and where should they be?
No, I think our potential growth rate still remains pretty high, Mythili. I don't think we can hit 8% immediately. It will take us a few quarters at least. But clearly, I think, as I mentioned, all the potential is there. We do have high savings even now, even though the savings rates are coming down. We have high savings. The good part is a part of these savings are now going away from land and gold into financial assets. We are one step away from converting that into actual productive investments. Hopefully, that will be the start of the next investment cycles, into things like low-cost housing and education. That could be the next big fillip to us, both in terms of employment as well as in terms of GDP. Yes, there are plenty of risks. The fact is we've had nice tailwinds over the last 3 years of global liquidity and of commodity prices being extremely soft and volatility in the global markets remaining pretty soft as well. Now, we need those tailwinds to continue for us to be able to reach our potential growth. But I do think the potential is there. We are on the right path. Hopefully, the worst is behind us. And therefore, good times ahead over the next few quarters. On the other issue of, assets, and I don't think we can really compare TARP with what we're going through out here. TARP was a very, very different situation in the US where the Fed had to directly pump in money and buy, paper and assets to alleviate the pressure of banks. I think what we are playing for right now, as Dr. Rangarajan is pointing out, is we need the projects which are stalled right now because of insolvency proceedings, etc., to eventually hit the road, start opening up the capacity, and therefore to start producing goods. We need that to happen. Now, How that happens is a question mark. When you say won't allow promoters to bid for it, it might create issues for banks in terms of them getting the best prices. But as long as we can get those projects up and running, it's good news for the economy as a whole. I think our focus has to be getting that up and running state as quickly as possible, besides just the accounting entries and the legal resolutions. We are going in the right direction. I still think there is merit in looking at better ways of getting those projects up and running, or completely scrapping them and selling them at fire sale value in a quicker way. Discussion for another day, but I think we are on the right path there.
Okay, so we are on the right path, and many ifs and buts, even though they are there, we finally should be able to get there, because we are way below our potential, and the potential is still quite high. So on that note, it's time for us to conclude this edition of Macros with Mythili, where we're discussing the ins and outs of the GDP numbers and trying to parse them for a better understanding. Thank you so much, Dr. Rangarajan Anand, for joining me in this discussion. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. In the meanwhile, if there's any other topic you'd like to see discussed in this program, do write in to us at the email ID you see at the bottom of your screen.